we've actually gone back to the fundamentals of insurance and said, let's rebuild this thing from the very ground up and be unafraid to question things that haven't been questioned before. Be unafraid to reimagine variables that, frankly, nobody really knows how they work anymore, because that guy
Yeah.
is 150 years in the past and it's just been iterated many times. Hi, everybody. My name is Carey Anne Nadeau. I'm the co-founder and co-CEO of Loop, and this is the future of insurance.
Carey Anne, it's good to sit down with you. Finally, been hoping to make this work for a minute, and then we got to meet in person recently, and that re-sparked this. So very excited, first of all, to have met you in person, but also to get to sit down with you and hear a little bit about your story and Loop's as well.
Yeah, it's really my pleasure. Obviously, I follow you on LinkedIn and on the internet and all of your thought pieces, and vice versa, I think is
Yeah,
true. It's funny
sure.
with COVID, everyone connecting virtually. It finally took us meeting in person to make a virtual connection happen. But
Yeah.
excited to be here, excited to chat with you and kick off a great conversation.
Oh, awesome. There was a lot at that conference. There was a lot of like, oh, you're much taller than I thought in person, which is the thought I had for you. And I'm like, well, I'm not just like a torso. I just like, that's all you know of me so far.
Yeah.
Um, so, all right, before we talk about torsos anymore, which might be a more awkward conversation that we might talk
See
about.
where the conversation goes.
Yeah. Um, just give us a little bit of background on you, because I think you have an interesting background, and you've done, from my perspective, done some cool things that I think a lot of people from the insurance side, like, yes, insurance heavy, but also interesting stuff along your path. So tell us a little bit about you.
Yeah, I can give everyone a little bit of background, a little bit of color. So my story, like many people in insurance, doesn't begin in insurance. My career has really been spent looking at um, data as a way to understand and inform opinion and decision making. So I was, as a child, very interested in these political talking head talk shows,
Yeah.
and I get so frustrated about, they're talking about topics that really affect a lot of people's lives around economic justice, around access and affordability, around the economy generally. And I felt, wow, for such a quantitative subject, how little quantitative evidence folks present in their argument. And so I was super highly motivated as this kid, just this idea that unfairness existed in the world and that information, data, I wasn't a very popular kid, but that data could be a way through which we could collectively kind of come together and understand the
Yeah.
world. I mean, I was very naive as a child, right? Believe that a politician would be motivated by data. It was its own disillusionment over time. But I came to find insurance actually through a roundabout way, as an industry that cares a lot about the quantitative evidence, that's making decisions using data and making decisions that really impact people's lives in a beneficial way. I'm not a finance bro, as you can tell. And I think insurance kind of has this idea of itself that it's the ugly cousin or the stepchild, or it's not sexy, right?
Yeah.
Because it's not finance. But what insurance really has going for it is that it's fundamentally established to be a social good in the world.
Yeah.
And I think that attracts a lot of people like myself who are motivated not because of the financial interest of starting an insurance company or writing insurance premiums or doing actuarial analysis for the fun of it, but because we believe that by offering affordable insurance to people who have assets that they need to insure, that we can be there for them in a time of need. And that, for me, that social good element, is the reason why when I go to conferences and find people like yourself, there's an immediate simpatico. There's an immediate sense of like, we're in this together for the good of society, not for the exploitation of people.
Yeah.
So I founded a company called Loop. I spent about 5 years knocking on doors in insurance, asking all the stupid questions, really getting up to speed on the basics and then how to play the game, which is its own level of knowledge. It's like you can play Monopoly and then some people can win at Monopoly. And so you're
Yeah.
learning the difference between those worlds, right? How do I buy property or how do I structure an insurance policy? But then how do I really use rates and how do I really use rules to do and accomplish what I want to do? So I founded this insurance company, or it's an MGA called Loop, and we sell car insurance. And the idea is that the traditional way of pricing auto insurance has the same underlying root problem cause that I try to attack in every thing I do, which is it feels a little bit unjust. It feels very unfair
Yeah.
to fundamentally evaluate people based on their credit score when they're applying for car insurance. The reason being is that we know that people who have lower credit pay more simply because they have less to insure, and that insurance companies motivated by looking to increase the lifetime value of a customer are looking to bundle customers who have home, who have boat, who have additional life insurance, things,
Yeah.
products they can bundle, products that they can buy from the insurance carrier. But what ultimately happens is the people who have the least pay the most, and the people who have the most pay the least.
Yeah.
And that doesn't really sit well with me. It's something I'm highly motivated to change. And so we did it. We did the hard work, which is maybe we don't get enough credit for, of removing credit score from the rating algorithms. We're the only standard auto carrier that doesn't use credit at all and has committed to never use credit from the start. We've
Yeah.
never written a single insurance policy that has used credit. We got rid of occupation. We got rid of education. We got rid of some of the barriers in zip code that make where you live differentially unequal, and just tried to sort of undo some of that institutionalized bias that makes
Yeah.
it more expensive for people with less to insure, and kind of correct for some of that. And we're having, great success along the way, I think. And we could talk a little bit more about some of the metrics of our growth. But how I really evaluate the success is that people are reacting, our customers are reacting. Our customers are saying things like, I've never had an insurer who represents me,
Yeah.
who is looking out for me, who's building a business that's custom designed for me. We have stories of people who have medical illnesses in their families, medical debt, people who are just getting out of college, people who weren't taught, and with student loan debt, people who weren't taught basic fundamentals of building their credit,
Yeah.
didn't understand how important it would be. Maybe 1099 jobs, you work at a bar, you work at a ride share, you don't have a W-2. And so these sorts of things compound for a lot of people when they realize that they're disadvantaged because they haven't established that credit, and or they're on the journey to rebuilding their credit. They need a provider like Loop that says, hey, we don't care about the things that don't matter when it comes to car insurance. We want to make sure that you're taken care of just like everybody else, that you have the insurance that you need, and that we can be a great provider for you
Yeah.
to do that. So
I,
that's kind
you
of the journey.
you
Mhm.
just said something that really blew me away. You said a few things that did, and first of all, like your childhood story and the way that I was like, I don't know if you're gonna pause, but if you're not, like, you just gave the whole genesis for Loop, and for people who don't know your story yet, like, I just saw it. I was like, yeah, this was forming in you as a kid,
Oh, yeah.
just like that sense of right, which was awesome. But you just said we don't care about what doesn't. I mean, you said it better than I'm gonna fumble it now. Like you don't care. We don't care about what doesn't matter
Mhm.
for seeing you as a risk for your insurance. And it's like, well, that sounds really basic and rational and obvious, and yet it's not the way we do things. I'm,
Mhm.
I'm about to put out my next book, and this is not me trying to plug it. So
No,
apologies
no,
to
I've read
listeners.
your books. I find them very interesting. So let's
Thank
go
you.
there.
um I literally in one of the chapters I kind of went off on credit
Mhm.
because I've been on stage talking about other ways to look at risk, and there's always someone in the audience who's like, raises their hand, but the regulators won't like it, and credit is, it's the golden standard. And I was like, well, tell me something. Is credit biased? Yeah, credit's biased. Of course it is. Like, and that's proven. It is well proven. Is credit a good predictor of some kinds of risk? Sure, like financial risk. perhaps, but not always and not
Mhm,
cleanly.
mhm,
But it's also completely uncorrelated to lots of other risk that we still use it for in the rating. And so for
mhm,
me, it's like, okay, we know it's not good enough. We know it's biased. We know it's uncorrelated to the thing
mhm,
that we're insuring. Why are people so stuck on
mhm.
insisting on it? Like it blows my mind. So
Yeah.
that's a
I
soapbox, but I figured like, yeah, you'd be on side with that.
I have a lot of thoughts about that because I've also been on the soapbox preaching the future of a creditless auto insurance industry, right? There is
Yeah.
a future. It's coming. It's unavoidable. Loop is in market, proving that the math doesn't work. So it's coming, like whether we
Yeah.
like it or not. But what I have come to learn is that there is an emotional resonance that we have when we talk about removing credit score. We really touch the hearts of insurance minded people who want to be doing something good in the world, who want
Yeah.
to say, to right the wrong, to take care of everyone equally, to fight injustice and fight fairness. Not everybody is motivated on that. I think
Yeah.
some people enter insurance because it's a very interesting financial instrument. It's fun math. I'm also a mathematician and a statistician by
Yeah.
trade, so I understand the joy that comes from the mathematical side of it as well. And for those people, I find a different argument is a little bit more resonant, a little bit more quantitative argument. And the case to be made here is that credit score is volatile for a variety of reasons unrelated to risk.
Yeah.
So what we're seeing today is that people with student loan debt have accrued credit. People are you or include I'm sorry, people with student loan debt have incurred hits to their credit, right? They haven't been able to build credit in the same way. We see people that are between 25 and 35 no longer getting married, no longer buying their homes, investing in things like commercial real estate, starting their own businesses, being okay with being with 1099.
Yeah.
So you've got this wave of people, you've got this wave of lifestyles that that credit varies not in correlation with risk.
Right.
So even if you don't believe, even if you're on the I know credit is highly correlated with risk, you have to understand that that correlation is less strong, or the dynamism in credit that isn't related to crash risk in this case does cause pricing inefficiency.
Hmm.
If we can agree to that, which I've brought a lot of people over to my side, that there's pricing inefficiency,
Yeah.
then it becomes about segmentation. It becomes about risk selection. And
Yeah.
that's where a company like Loop really excels because we're willing to look at alternative sources of information. We're willing to look at the importance of things like the roads that you drive on as a predictor of your losses. If you're driving on roads that have a 99% probability of a crash every single day on your morning commute, I care to look at that information more than I care to look at your credit risk because that doesn't isn't as volatile and is more highly correlated with the thing that I care about.
Yeah.
So I think there's just two arguments, right? There's the emotional, heart-based, moral, social justice argument that I strongly believe in. And then there's a quantitative argument. And if you're not convinced by either of them, I don't know what to do with you. But I think there's a good case
Yeah.
in both regards to saying that the future of auto insurance in particular, it will not include credit. There's just
Yeah.
no viable 10 years from now, if I think about the future, that we're still using credit.
Yeah.
You mentioned regulators. I want to touch on regulators because I
Yeah,
love
please, because
regulators.
that's like a common push. Oh, but the regulator, we can't use AI because the regulators won't let us. Like, won't let you? Are you
Mm,
sure about that? Yeah.
hmm.
So let's talk about that.
Yeah, so my background, I skipped over a brief period that I spent about 10 years in academia and at research institutions like
That's
the
what I was
Brookings
hoping you'd hit
Institution.
on when I was like the different kind of things you've done. But yeah, fill
Yeah,
us
yeah.
in.
I spent 10 years in academia. So I've committed my life to studying urban studies and how and in what ways urban policies have created the reality that we see today, but some of the social and economic dynamics of people who are poorer, living in the suburbs, lacking access to transportation, public transportation, needing to own a private vehicle in order to get to places like the grocery store or to drop their kids off at school because they don't have the same mobility necessarily that someone in a more urban environment might have.
Yeah,
And in 2008, we saw a dramatic release from cities. People moved out of cities into the suburbs. We saw it again with COVID
for
19.
sure.
It's sort of a cyclical thing, and city planning happens all the time, right? It ebbs and flows, the concentration of people in cities. But in this weird way, I never thought insurance and city planning would come together. Like, I never thought, like, okay, I'm going to go to school to study city planning to pursue a career in insurance. Those two things just feel like oil and water. But
Yeah.
in reality, they're actually really closely tied because regulators care deeply about the impact of redlining, about the
Hmm.
impact of differential services for specific communities, particularly communities of color, low income communities, single moms. They care about the public interest in that
Yeah.
way, and making sure that people are getting a fair shake. They're actually kind of on the same side as Loop in many ways because they want to see an alternative that doesn't disproportionately discriminates, but disproportionately benefits the people that this incumbent system does discriminate.
Yeah.
Because we can measure that, like, if you're in this zip code versus that zip code, if you're in a lower income, mostly apartment rentals zip code versus a higher income. And I'm so insulted by the way that insurance talks about the Robinsons, like the white picket fence, the two kids, the dogs. They're unabashedly saying, like, this is our customer and this is who we're
Totally.
targeting, even though the vast majority of society doesn't look like that prototypical family and frankly, white family. Um, and so what you get is a regulator who says, look, like, you see these two zip codes, and what we show them is crash risk. We say there's an equal probability of a crash based on public information that says,
Yeah.
here's where all the car crashes happen in this poor neighborhood and this wealthy neighborhood. Go ahead and explain why the zip code is different. Go ahead.
Right.
Like, tell me why you don't want to sell in that neighborhood if crash risk is identical.
Right.
And so what Loop did was offset some of that in our zip code rating. So now people that used to put their aunt's address to get a better rate because they knew how to game it. They're
Yeah.
not stupid. They know how to
Yeah.
game the rate. They put their address at somebody else's address to get a better rate. Now they can have the human dignity of saying, I'm from this neighborhood. This is where I'm from. This is my address, and still get a fair shake in the system, not have
Yeah.
to squirm around it to get fairness, unfortunately.
Well, so what I wanted to ask you is to make that a reality from
Mhm.
from a practical standpoint. And I totally agree with you, whether it's 10 years, 8 years, 12 years, whatever is not the point. At some point in the not too distant future, I agree with you. I do believe that credit will be gone, just like the
Mhm.
days before it was being used. And there was the question of could we use it or not? And then it became the norm. I think we will go through that progression. But from a kind of practical standpoint, and you're living this, how does Loop assess, evaluate price risk
Mhm.
without that? What are the mechanisms you're using? And you mentioned like what streets are you driving on? Is it an IoT solution? Is it
Mhm.
a phone app? Like how do you get the data you need to look
Mhm.
at risk differently?
Yeah, I mean, I think there's no silver bullet, right? I think one of the big mistakes, or the learnings, I should say, from insurtechs that have come before us, is that you can't just say AI and pray that it works, right? You
Yeah.
actually need to invest in alternative sources of data. You need to invest in evaluating whether they're good predictors of risk, and you need to monitor that over time. So
Yeah.
there's no I have this one magic wand that I wave. As much as our investors or Silicon Valley might want to believe that AI is magic, it's
Yeah.
not. It's hard work. It's what people decide to put into the system that ultimately determines the performance of a model. So it is always tied back to the original data that you look at. And statistics 101, garbage in, garbage out.
Yeah.
So that's where we start. We start with the rating factors. We start with the rating tables. And rating tables are 150 pages of the most boring spreadsheet you've ever read in your whole life. But deep down in there, you start to read the tea leaves and you can see some of the decisions that were made about how to structure the rates, how to incentivize some people to win in the game of insurance to get more affordable rates, and how some things may be you want to question, well, why should we continue doing it that way?
Yeah.
Some of the fun discoveries, I mean, just anecdotally, we found out that Progressive is discounting luxury vehicles for people over the age of 65. Why?
Okay.
It's like, maybe because their executives come to work every day in these vehicles. I don't know. I, I don't know why. But there's all sorts of things that we bake into the way that we evaluate risk and assumptions that we make about that it works. Um, what we're doing is challenging a lot of those assumptions. So, is the zip code territory fair? Not if
Yeah.
you look at crash risk at a localized level. Not if you say, look, this neighborhood versus that neighborhood is the same identical crash risk. If zip code is meant to be a proxy for the probability of crashes near the places where you live and the roads that you're most likely to drive on, let's look at the roads themselves instead.
Yeah.
However, they did it, frankly, some of these things are really hard to disentangle because their pieces are confidential, they're interacted with other variables. But if I can't explain it, if I can't understand why it is the way it is and why it's structured that way, that to me is also a good signal that it's potentially garbage in, garbage out, or it's an unexplainable model. And
Yeah.
why that's so important is because when I look back on my performance and I say, all right, why did I perform the way that I performed? If I can't explain why some variables operate the way they do, I can never really appreciate the performance.
Yeah.
So I think, for us, the big difference is not that we have a magical AI system. It's that we've actually gone back to the fundamentals of insurance and said, let's rebuild this thing from the very ground up and be unafraid to question things that haven't been questioned before. Be unafraid to reimagine variables that, frankly, nobody really knows how they work anymore because that guy
Yeah.
is 150 years in the past and it's just been iterated many times,
Right.
copied, pasted, adjusted for specific
And we've
marketing
just
campaigns.
accepted it. We've accepted it, and so people aren't questioning it, but actually they really should. Just because
Mhm.
we already use it doesn't mean it's right or okay or helpful.
Well, I would love to see the report on credit. That's one that people loud all the time, right? The
Yeah.
guy raises his hand and says, no, but credit is actuarially justified. Where?
Right.
Where? Show me. I've been in this business for 5, 7 years, never seen a single report other than one written by Bernie Birnbaum in 1995 that showed that credit was disproportionately biased and that we shouldn't be using it
Yeah.
and that nobody paid attention to then, but is still very resonant to me.
But
There is no
even if it,
public accountability related to credit scores and their
yeah.
impact on people of color. There is no accountability related to the dynamism in credit that's happening right now that's disproportionately affecting people who have blue collar jobs, who work in the gig economy. It
Right.
is it is making their insurance vastly more expensive. A
Yeah.
typical insurance policy is $1,100. For these folks, they're paying more like $1,600 to $1,800, and that delta has nothing to do with their risk.
Right.
So I'm not talking about disproportionately, I'm not talking about lowering people's rates to bargain basement. I'm giving them an average price and giving them a fair chance like everybody else.
Yeah. Yeah. Um, you know, even if you saw that report and even
Mhm,
if it was justifiable at the time,
mhm.
um, it doesn't mean it always will be. And for people who hold this up as like, but we've been doing it this way for X hundred or decades or whatever years, that's fine. But you're also precluding yourself from any progress, opportunity, development, and we
Yeah.
have enough examples where, like, you look at the top 10 auto writers in the country over the past decade, only one of them has made money on auto, and that's Progressive.
Right.
Um,
And what
and
do? They invest in data and they invest in
they invested in
alternative
it. They've
ways
got
of looking at risk. Mhm,
so much more advanced rating approaches and segmentation and everything. And
mhm,
I always share the story that I worked at one of the other top 10 years ago. I started at Liberty Mutual, and we had four rating tiers, and we jumped from 4 to 20. And I was there for that change. And it was like, this is game changing for us, the profitability impact and the better pricing.
mhm,
And it was this huge unlock. At the time, Progressive had 80,000 tiers. It was a
mhm,
smooth curve. And we were like, it was like walking up a staircase.
mhm.
And it's just like, how are we going to compete with this? Like
Mhm,
yet the industry continues to latch on to these things and pat
mhm,
ourselves on the back. It's like, well, we already have the example of what better looks like. What if you did even better than that?
mhm,
Like,
mhm.
you want to lose
Yeah.
money, that's totally fine. Go right ahead. You can continue on. But
Mhm. Yeah, but
um,
you're hitting on the fundamentals there, which is that segmentation matters and that
yeah,
we don't just stop at like 2005 in that quest, right?
right.
Like we can keep going and we should keep going. And it's going to take companies, I think, like Loop that exist outside of the incumbents
Yeah,
to show what is possible. I think our future is bright. We're growing a fast growth VC backed insure tech company.
yeah,
And there's a couple of bodies on the road that thankfully, I will say, being the second mover, we've also been able to learn from. And so I would add on top of that sort of diligence in old fashioned underwriting is also incredibly important.
yeah,
Um, the myth of AI in insurance is that you can get the perfect rate for everybody, right?
yeah,
That you can get a perfect distribution that fits with zero pricing inaccuracy because you've got this model that considers multiple variables simultaneously and interactions between variables and telematics data. Let's throw that in there, real time information about where people drive. We're going to be able to perfectly price everyone. And the reality is that our ability to price at the tails, people who are extreme, people who commit fraud, people who just are act or behave differently than
yeah,
others. We'll have customers, for example, that drive 100 miles an hour in the first week of their policy. I'm like, no thanks.
yeah,
Like, I'm good. There's no price I can offer you that will ever recuperate the catastrophic car accident you're about to get in if you're willing to be that risky on the road.
yeah,
So for us, some of what the future looks like is learning from that passive insure tax that maybe trying to use AI again as that magic wand and forgot some of the fundamentals of insurance, which also need to be a part of this future. It's not an abandonment of the old ways, it's a refinement and taking forward what really does work. Good
yeah,
old fashioned underwriting, good old fashioned good discretion around who you're willing to insure and who you say there's a policy for you elsewhere.
yeah. I'm just catching the time. I'm like, well, we
Mhm.
honestly like we could probably spend the entire day.
We can come
Or maybe
back.
it's like a,
Part
a
two.
seven part a seven part series, I think would be hard for us to do. But I do, before I let you go, there is one thing I want to ask you about that. Being in the position you are at an insurtech startup, when there's this sort of Gen 1 folks who, quite frankly, did not all of them, but some of them did not take underwriting as important as perhaps they should have. They
Mhm,
saw it more as like a B2C tech story, and that's get more, and like even though you're selling dollars for 20 cents, somehow more of them is better.
mhm,
Um, but then there is this newer generation, and what bothers me, especially on LinkedIn and some of the other platforms, Twitter, is the lumping together and the group judgment,
mhm,
and sort of dismissal. And there are a number of these sort of Gen 2, or maybe it's Gen 3,
mhm,
insurtechs that are actually growing appropriately, performing well. And yeah, you're still a startup. I wouldn't expect profitability yet, but there's something to be said for living through the kind of macroeconomic pressures that
mhm.
are going on. And because you've been doing that, I wonder if you just sort of comment on, it's a tough period. The big forebearers of what you're doing have not done very well, and that brings a lot of negativity. Any kind of words of wisdom of living through that
Yeah.
tough reality, and performing well and growing through that despite what the headwinds.
Yeah, thank you for separating out Loop into another lane. I do believe that we are the third wave of insurtech that's coming now. The first wave of insurtech was really kind of our old days of esurance, right?
Yep.
Digitizing the experience, getting people into a phone was a big step that needed to happen. And then you saw a second wave of insurance that was really thinking about pricing innovation, thinking about introducing AI, but maybe didn't have the fundamentals of insurance totally considered. And then this third wave of insurance is building on top of that experience and
Yeah.
saying, like, we can take what we saw in the second wave that now in public markets is not performing well, right? They grew at all costs with little accountability outside of their investors to
Yeah.
performance. VCs don't know insurance very well, right? Let's just be honest. It's a very complicated business model. They're used to looking at SaaS businesses. They're used to looking at subscription services where you could take a granola bar or you could take a gym and the pricing models and the financial models look the same.
Right.
In insurance, it's totally different, right? It's a very complex financial model. And it's one of the only industries where when you acquire a customer, they can cost you money, right? So
Right.
understanding that dynamic in the VC world is a challenge. But VCs and reinsurers have never been more aligned. They're looking at profitability, they're looking at performance, they're looking at trajectories towards profitability, right? Insurtechs that may need capital to start out and to grow, but have a reasonable path within 24 months, 36 months into profitability, right?
Yeah.
And so I think where we find ourselves in a more macroeconomic environment is that people are looking for capital efficient businesses that know how to acquire customers very well, and ones in insurance where the risk segmentation and the risk modeling makes sense so that the long-term performance of the business isn't encumbered by that fast growth, grow at all costs, because it will come back and bite you sooner or later when you see at least the public market comps. More broadly, I think about the macroeconomic environment in tech as well, and the reality that Facebook has made layoffs, Google is making layoffs, Microsoft. I mean, if you just open up the newspaper every
Yeah.
day, it's another big tech company going through a massive round of layoffs. So it's not just the tech companies and insurance, it's also more broadly that we're seeing a return to capital efficiency. We're seeing a return to performance metrics. Some of the bloat that was there in a bull market is no longer there in a bear market.
Yeah.
And it's important that we seize this opportunity to do a couple things. One, to acquire great talent that otherwise we would not have access to, because frankly, it's hard to compete with Google
Yep.
talent. But two, that I've always used this mantra of pace and focus. When other people slow down because they get tired, if you're that guy on the track, it's just going, staying steady. You don't even have to speed up, but you stay in the game and you figure out how to just keep your pace and keep your focus while everyone else is slowing down. You look like you're going faster than everybody
Yeah.
else, even though what you're doing is remaining diligent, you're remaining focused, you're remaining disciplined.
Yeah.
And that's what I believe are going to be the companies that come out of this recession or this potential recession. Are companies that understand the fundamentals of how to operate a good business. And we're probably going to be better off for it to have companies that are long-term viable, companies that can get to IPO and perform in the public markets versus dumping some of the cost of their performance on public investors, right? We should be able to see companies that come through this on the other side that understand how to run, how to operate a successful business. My fingers are crossed that my leadership, along with my co-founder, John Henry, puts us in that category. And I think we're doing the right things to survive and to thrive in this market. But we'll see what it throws at us next.
Yeah.
Bank collapse was a fun one. Didn't expect that one. So
Yeah.
we'll see what comes next.
I think there's a lot of things that we just sort of take for granted, and we assume like, oh, that's a 1920s or maybe 2008 kind of issue. In 2008, folks stepped in, and yeah, it was quite a shocking weekend for.
Mhm.
Yeah,
I
a lot of text
graduated.
messages that weekend for me.
Oh yeah, I graduated college in 2008. So I am of the generation that understands very much how difficult economies can get very
Yeah.
quickly. And I survived that one. I've thrived in building my career, my business through it. And it's just that pace and focus. Stay determined and focused on your goal and operate through it. Be the
Yeah.
operator. It's a real test of performance though, because you have to make difficult decisions. You have
For
to
sure.
make choices around growth and compromises around growth. how you're going to grow your team, how you're going to grow your lines of business, how you're going to respond to other insurance companies that are raising rates. That's an interesting one for us, right? You see the market take the opportunity to increase rates 13% on consumers after a year where they were some of the most profitable lines of business because they misestimated and didn't judge properly the impact of COVID. Meanwhile, I'm over here saying, hey guys, I have the data on road risk that says crashes are becoming more prevalent and more serious. You're making a big mistake that then now we're seeing the consequence of and shift back onto consumers. Well, that's one way to make the decision. It's not the way I would choose, or I am choosing to do it, but there's a lot of difficult choices companies are going to have to make. And I think, the wheat is going to separate from the chaff, the cream is going to separate from the milk, and you'll see the companies that are true operators perform through this.
Yeah, I think that's really well said. Carey Anne, it was great to pull from your brain, for lack of a better phrase. Like it was, I think it's a really interesting moment in the industry where, we have Loop, we have a few others that are starting up with that kind of underlying principle of what this industry is supposed to be in the first place, a social good, and building it the right way. And I really appreciate that. So, best of luck to you and John and the rest of the team. And we need it. Like this is the kind of push that the industry needs to get on the right side of things. So thank you for spending some time with me today.
Oh, absolutely. Let's make it a habit. I'd be happy to come back if you would invite me and touch on more subjects. This has been really fun. Thank you for having me.
We got parts 2 through 7 to do still. So
yeah. Stay tuned. Stay tuned.
Thank you to Carey Anne for spending some time with me, with all of you, and sharing what I think is a really important message, not just about what Loop is doing and, sharing about the company that she and John Henry are building together, but what it could mean for the industry. And like I said, I agree with her. I think that we are going to find ourselves not too far down the road, but a little bit down the road in an industry where we look back and we're like, why were we using credit the way that we were? Why were we looking at these other factors when they're not only biased, they're also not correlated to risk the way we thought they were, or as much as these other things that we've now come to depend on that are not biased, or not biased to the same degree. Or maybe in the same ways, in the ways that they are biased, we can actually counter through these other factors. There's possibility when you do that. And so my ask to all of you, whether you love credit, you're against what she's saying or not, just be more open to wondering and being willing to say, well, what if I suspended disbelief and allowed for this for just a minute? Because I do see this sort of like gut reaction to be like, no, this is the way. What if you just allowed for the possibility that something different may be a better answer, and then see what happens? You might end up convincing yourself. And if you don't, you might end up with a better, clearer argument than just sort of, digging in your heels, which doesn't tend to convince anyone of anything. But you may wind up with a better set of explanations, factors, rationale that the people who think different from you might say, actually, that's a really good point. But if you're just sort of dug in, you're not gonna make any progress in either direction. So I love that, Carey shared a lot of different things. It's just stuff that we should be planting seeds and thinking about and saying, well, what if that was true? Then what? What does that mean for me? What could I do with that? That's the kind of mindset I think we need in this industry. So thank you to Carey Anne for joining, to the team at Loop for giving her up for a bit. And, I mentioned a new book coming out. That is available at future-of-insurance.com/3, because it's the third volume in the Future of Insurance series. It's all about collaboration in the industry, which is what this is all about, working together. Risk is pooled. That's a collaboration in the first place. So shouldn't we learn about how to be better collaborators between the traditional insurance providers, the carriers, and solution providers, new insurtechs that are coming on the scene? How do we work together better, faster, smarter, for better results, to better the outcomes for everybody? So hopefully that's interesting to all you. Again, future-of-insurance.com/3. All right, I will see you back next time for another episode. And keep asking yourself, what if I allowed for that? What would that mean for me? Challenge yourself that way. Challenge those around you. Get them to ask that question and see what's possible for all of us. Thanks, everyone.